Hello, this is Professor Broker, and this is your third installment for Chapter 13, Econ 231, called The Cost of Production, Part 3. Let's go ahead and get started. Okay, so as we were discussing before, we talked about the various types of costs that a business might face. We might lump some cost into a category called fixed costs. These are costs that do not vary with output. We also had variable costs that did vary with output, right? And then those together gave us total cost. Total cost equals fixed plus variable. Okay, remember with the concept of marginal cost. This is how much cost is changing as we change the units of output. Specifically, produce one more unit of output. How much extra does it cost us? Okay. And then average total cost told us the typical cost per unit. This was found as total cost divided by quantity, total cost per unit, right? And then also we said that average total cost is also going to be equal to the average fixed cost, okay, which is the fixed cost divided by quantity plus the average variable cost, which is variable cost divided by quantity. Okay, remember we had our typical U-shaped average total cost curve and our typical upward sloping marginal cost curve. And we said we had a special name, if you'll remember, for where these two curves intersect. And we said that is the efficient scale. That is the minimum of average total cost when marginal cost equals average total cost. Okay? Now, when talking about average total cost, some portions of it they decrease. Some portions of average total cost decrease as output increases, which is what we see here on the graph, and we have a special name for that. Okay, it's called economies of scale. A firm is experiencing economies of scale whenever they increase output and their average costs per unit actually go down. Okay, actually go down. It's actually a sign of efficiency gains. Okay, let me just give you an example of that. Let's just say you decide to start a car wash. You buy a water hose, you buy sponges, you buy soap, okay, totaling obviously $40, okay, all of that together. So all of those costs cost you $40. Now, when you wash the first car, what is your average cost? Well, clearly, it's the $40 of total cost divided by only one car that you've washed. Your average total cost is $40 if you only wash one car. But now what happens when the second car rolls up and you say you wash two cars that day or in an hour? Well, then you would take the $40, divide that by 2, and now your average total cost is only $20, okay? And so obviously the average total cost has gone down as your output increased. This is an example of economies of scale. Okay, firms, especially when they start out small and as they grow to a medium-sized business, they typically can experience economies of scale. Sometimes you might see it on the news or business leaders talk about it as going to scale. We need to take it to scale. Usually what they're referring to is economies of scale. They want to experience efficiencies as they get bigger. They want to see declining average costs. Okay. Then there's times when your average total cost can remain constant as you increase output. This is constant returns to scale. And then there are times, this is maybe typically true as businesses get larger and larger. Okay, again, not always, but just generally speaking, it can be true when businesses get so large and they continue to get larger, it can actually increase their average total cost, as you see here on the curve, which we would call diseconomies of scale. Typically, you don't want to experience diseconomies of scale. It would actually make efficiency sense for a firm that's over here on this portion of their average total cost curve to actually get smaller, decrease output, and they could actually reduce their average costs by doing that. So you have economies of scale, constant returns to scale, and diseconomies of scale. Usually, each firm will have sort of a long-run average total cost curve, and they can be on various portions of that curve at various points in their existence. Okay, and basically this just says that economies of scale is more common when quantity is low for maybe smaller firms or firms just starting, and diseconomies of scale can be a little bit more true when quantity is large, companies are large, management becomes stretched, it's hard to control costs, there can be coordination issues, and so on. Okay, now let's talk about some revenue, cost, and profit concepts. Okay, what is the goal of, if I asked you, you get up in the morning, you get in your car, you're going from your apartment to campus, what's basically your goal? it's probably to get from point A to point B, probably about as quickly as you can. I mean, within certain limits, right? You're going to probably stay on the roads. You're probably going to try to go, obey the rules of the road and so on. You're going to stop at red lights and so forth. But you're probably going to try to take roughly the quickest way that you think will take you the quickest way to campus. You want to minimize your driving time. Okay, that's Now, is that always true? Of course, it's not. Right? That's not going to explain all driving behavior. But I bet it's a pretty good bet that if I make that assumption that the main goal of most drivers is to get from point A to point B roughly as quickly as possible, that would help me understand most driving behavior. And most routes that people take to and from work and so on and so forth, right? And in roughly the same way, that's kind of like our assumption that we make about firms in these next few chapters. We're going to be assuming that the main goal of firms is to maximize profits. Now, of course, there can be other goals, trying to improve the world and trying to help people and things like that. Obviously, these are goals that some business owners have too. But if we make the assumption that, they're trying to make money at the end of the day, that can actually help us, I think, explain the vast majority, if not almost all, of firm behavior out there. Not only, in the real world, and so we're going to make that assumption, which I think will be helpful for our models. So let's talk about profit. Profit's simply going to equal total revenue minus total cost. It's pretty basic. Total revenue is simply price times quantity. If I go in to the quad and I'm selling ice cream cones, if I sell 200 ice cream cones at $2 a piece, right, my total revenue is $400. That's not the profit I've made. That's the total revenue, the amount of cash flow into my business, right? I would then have to subtract my total cost, the market value of inputs used. So, maybe all of my costs for the ice cream and labor and so on and so forth is $300. Well, then my total revenue, $400 minus my total cost of $300 would leave me with a profit of $100, right? Now, when we talk about profit, actually, when we talk about cost as well, we really can approach it from two different vantage points. And when we've been talking about cost up to this point in the chapter, I've really been assuming that we're looking at it from an economic standpoint and not an accounting standpoint. And these really are two different approaches. So when accountants look at profit, they're going to mainly look at it from a cash flow perspective. And so they're going to look at total revenue into the business minus total explicit costs that we can tangibly see leaving the business's hand, writing a check, leaving the checking account, whatever. Money that is tangibly being spent, maybe on resources, on wages, whatever. These are explicit costs. Whereas economic profit is really total revenue minus our explicit costs, yes, but also economists are concerned with resource allocation. So we're going to include what we call implicit costs as well, which are basically opportunity costs. Okay? And so economic profit's always going to be, it can be equal to accounting profit, or usually it's going to be much less than accounting profit because we're actually adding in an extra layer of costs here. Okay? And now, when we've been talking about costs previously in these lectures, we've been assuming that we're including both explicit and implicit. Okay? So let's talk a little bit about those differences. Okay? Again, explicit costs are going to require a specific tangible outlay of money. This is like paying wages to workers. Money is literally, you can see it in the spreadsheets, it's literally leaving the business and going to the workers. Okay? This is an explicit cost that businesses have. Paying utility bills is explicit. Then there's implicit costs. This does not require a specific cash outlay of money. In fact, it usually is not an outlay of money. So, for example, maybe a business owner started a car wash, but maybe they quit their job as a professor at the university to go start a car wash. Well, there's nothing inherently wrong with that. They start the car wash, maybe they're making money, but the economist would say, but one cost we need to include in our cost is what you could have earned if you had stayed a professor. Okay? And so we would count that as an opportunity cost of the owner's time as an implicit cost in our economic profit calculation. Okay, and the reason we do this is because, remember, one of the 10 principles of economics, the cost of something is whatever you give up to get it, not just monetary outlays, not just cash flow, but whatever it is, whatever resource you expend to get something. If you quit your job as a professor to start a car wash business, you are reallocating your time, and the economist is going to try to calculate basically the costs and benefits of that decision. Okay. So let's look at let's just say you recently quit school to start a car wash business. Identify which costs are explicit and which are implicit, right? The water bill you're going to pay obviously is an explicit cost. The buckets and sponges, those are explicit costs. The time you quit going to college, right? This would obviously be an implicit cost. College graduates tend to earn much more money than their non-college graduating counterparts in the workforce, and so you have most likely given up potential earnings in the future by quitting college and starting your business. Now, so that time, the value of that time is an implicit cost that economists would try to capture. Wages to workers is an explicit cost. The land you own, okay, the land you own. This one's a little tricky. But think about it. If you own the land, do you have a rent payment or anything like that? No, of course you don't. Let's just ignore upkeep and maintenance for right now. And you're not really going to have any explicit cost with the land you own. But will you have an implicit cost? Okay. Well, let's say you own the land, you start a car wash business. What else could you have done with that? Right? You could have leased it out to some other business. Maybe you could have leased it out to a whatever, to maybe an ice cream shop or some sort of storefront, or maybe a different car wash business. They could have just paid you to have their car wash business on that land, but instead you're using it. Now, that doesn't mean it was a bad decision. It just means that you could have used whatever the value, the next best value you could have got out of that land. That is your implicit cost for using it for your car wash. Okay. What about the $10,000 you pulled from savings, where it was earning 5% interest, right? If you pull the money from savings and are using it to start your business, that means you didn't have to borrow money, so that's good. You don't have to pay an explicit cost of interest. But if you had left the $10,000 in savings, you could have earned 5% interest on it. The fact that you used it for your business means you're missing out on that foregone interest. That is an implicit cost. An economist would count it, accountants wouldn't. Okay, so again, it's just two different approaches of looking at costs and resource allocation and profit. Neither is right or wrong. It's just two different approaches. So let's do another example with implicit and explicit costs. Let's just say you need $100,000 to start your business. The interest rate is 5%. In the first scenario or case, you're going to borrow the entire amount. You're going to borrow $100,000. Okay, obviously you're going to have to pay that back, and the cost of borrowing that money is going to be the interest rate. The interest rate is 5%, so you're going to have to pay a price of 5% on $100,000 in 1 year's time. That would be $5,000. This clearly would be an explicit cost. An extra $5,000 would be coming out of your bank account and going towards the bank, right, in order to pay for the money that you borrowed to start this business. Okay, both economists and accountants would count the explicit cost here in this case. Now, scenario 2, let's just say that you've got $40,000 in your savings. So in this case, you use $40,000 of your savings and you only have to borrow $60,000. Okay? Well, now the explicit cost in this case has gone down, hasn't it? Because you only are going to have to pay interest on the amount you borrow. 5% times 60,000 would only be 3,000. Okay, so your explicit cost goes from 5 down to 3,000. The accountant would stop right here and say, "Whoa, this is a much better scenario. You have less explicit costs." Okay, and so this most likely would be the better scenario, right? Because your costs are lower. But the economist would not stop there. What would the economist point out? The economist would point out that, yes, you saved on having to pay interest to the bank, but guess what you didn't save on? Guess what you didn't earn? Your $40,000 could have remained in your savings account where you could have earned 5% interest, right? Which would have been 5% times 40,000 is 2,000. So you have $2,000 of foregone interest that you gave up because you used your money to start your business. That doesn't mean it was a wrong decision. It just means that the economist is going to count that, even though that money is sort of phantom, as it were. It's foregone. It's not going to be in an Excel spreadsheet somewhere. the economist would count it because it's an opportunity cost. It's an implicit cost. Okay, so really the accountant would say case 1 is cheaper, it has case 2 has lower costs. The accountant would say. The economist would say both of these are really costing the business the same amount, and you should really be indifferent. Okay, because in both cases, to the economist, the total costs are $5,000. Okay, let's do a couple more examples. Which of the following would be an example of an implicit cost? Foregone investment opportunities, number 1, that clearly would be. Wages to workers, no, it's not. Number 2, it would not be considered one. And so we can automatically eliminate B and C because wages to workers would be an explicit cost. And then 3, raw material costs, that too would be an explicit cost. And so we can eliminate D. So the answer has to be A, 1 only, right? Foregone investment opportunities. Another example, let's just say the equilibrium rent on office space is just increased by $500 a month. Let's compare the effects on accounting profit and economic profit. If A, you rent your office space, or B, you own your office space. Okay, hopefully you can kind of think through this. Obviously, if you're renting your office space, right, your rent is an explicit cost. So an increase in your explicit costs is going to decrease both accounting and economic profit by $500 because both accountants and economists will recognize the increase of explicit costs by $500. Okay. Now, in the second scenario, when you own your office space, right, the accountant would say you don't have an explicit cost. You're not paying rent if you own the office space. So the accountant would actually say if your rent, if equilibrium rent prices of office space in your community goes up, the accountant would say your profit is unchanged because you don't have any explicit cost of rent or anything like that. And that would be true from the accountant's perspective. But from the economics perspective, right, your implicit cost, what could you do with your office space if you weren't using it for your business? You yourself could rent it out to a different business, right? Or just somebody else. And so the amount of money you could earn if you rented out your office space has just gone up by $500, which is another way of saying your implicit costs would go up by $500 in scenario B. Therefore, your economic profit would go down by $500. So again, part B, explicit costs don't change, accounting profit doesn't change, but implicit costs would increase by $500, thus reducing economic profit by $500. It depends on how you're looking at this, the scenario, how you're approaching the cost concepts, and what the scenario is in terms of renting versus owning. How are you controlling that resource? Do you control it, or are you renting it, or whatever? Okay, final example. Let's say Zach withdrew $400,000 out of his personal savings account, okay, and he used it to start his new cookie business. The bank account pays 3% interest per year. During the first year of his business, Zach sold 6,000 boxes of cookies for $2.50 per box. Also, during the first year, the cookie business made monetary outlays, aka explicit costs, of $9,000. You may assume that there's no opportunity cost to Zach's time. What is Zach's accounting profit for the year? Okay. Well, to figure out his accounting profit, what are we going to need to do? We're going to need to do total revenue, right? Which is going to be what? Well, it's going to be the 6,000 boxes of cookies times, that's the quantity, times the price he gets per box, which is $2.50, which is going to be $15,000. And we're going to need to subtract what kind of cost? Just his explicit cost, which the problem makes it very easy. They tell you exactly what his explicit costs are, right? It's exactly $9,000. And so $15,000 minus $9,000, the accountant would tell him his profit for the first year was $6,000, right? Pretty straightforward. Okay? But now let's use the same scenario and find Zach's economic profit. Okay? What would it be? Again, total revenue would be the same. 6,000 times 250, 15,000. Explicit costs would be the same, 9,000. Would there be any implicit costs? Okay? There is no opportunity cost for his time, the problem says. Okay? So there's no opportunity cost for his time, but what is there an opportunity cost for? How about that savings money, right, that he could have earned 3% interest on during the year? Right? Sounds like foregone interest to me. Okay? And so that's an implicit cost that we need to calculate. So his explicit costs are 9,000. His implicit costs are going to be 12,000, the 3% times 400,000. Thus, his profit is 15,000 minus the 9 plus the 12,000, which is actually going to be negative 6,000. In other words, on paper, it's going to look like that he made a profit from the accounting perspective, but the economist would come along and say, actually, you would have been better off monetarily just to leave your money in the bank. You would have made more money that way. I mean, in other words, I mean, you started this business and you would have just made more money if you had just left your money in the bank. Okay. And again, that doesn't mean he shouldn't have opened the business. Again, there's other considerations, but if we look at this from a strictly numerical standpoint, his resources would have been better served just earning the 3% in the bank account. And that's what the economic profit tells us. Okay.